Open a ZERODHA account. 9. Trading Psychology and Risk Management Chapter 1. Orientation Note Chapter 2. Risk Part 1. Chapter 3. Risk Part 2. Variance and Covariance. About. Open a ZERODHA account. Chapter 1. Orientation Note. 1.1 A unique opportunity. I'm excited about this brand new module on Varsity, wherein we will be discussing two important and closely related market topics, risk management and trading psychology. While risk management may seem straightforward, psychology may sound boring. Trust me, both these topics can potentially open up new realms of trading. Risk management, for instance, is not what you are thinking. It goes beyond the usual topics of position sizing, stop loss and leverage. While trading psychology is a reflection of your actions in the markets, helps you introspect and find answers to why and how you made a profit or a loss in a particular trade or investment. Given the exhaustive nature of these topics, I tried looking for ideas on how best I can structure this module and what chapters to include. And to my surprise, there are no contents related to these topics. Of course, you can find tons of content online, but they are all fragmented and lack continuity. This gives us both the opportunity and the responsibility to develop some dependable content around these topics, centered on the Indian context. We will have to work as a team here. We will take up the responsibility to post the content and you will have to take up the responsibility to enrich it by posting queries and comments. 1.2 What to expect. At this stage, I can give you a brief orientation on what to expect. However, as we proceed, if necessary, I'll take the liberty to alter the learning methodology, although not too drastically. So there are two main topics we are dealing with here. Risk management, trading psychology. Risk management techniques vary based on how you are positioned in the market. For example, if you have a single position in the market, then your approach to risk management is very different compared to the risk management techniques of multiple positions, which is again completely different compared to the risk management techniques of a portfolio. Given this, we will look at risk management from multiple angles. Risk management from a single trading position. Risk management from multiple trading positions. Risk management for a portfolio. In my attempt to explain the above, I will cover the following topics. Risk and its many forms. Position sizing. Guess this one is mandatory to cover. Single position risk, multiple position risk, and hedging. Hedging with options. Portfolio attributes and risk estimation. Value at risk. Asset allocation and its impact on risk and returns. Insights from the portfolio equity curve. I'm guessing these topics will give you a completely different perspective on risk and how one can manage risk. Further, we would be discussing trading psychology both from a trader and an investor's perspective. The discussion would largely involve cognitive biases, mental models, common pitfalls, and the thought process which leads you these pitfalls. Here are some of the topics we would be discussing in this section. Anchoring bias, regency bias, confirmation bias, bandwagon effect, loss aversion, illusion of control, hindsight bias. Of course, we will build upon this as we proceed. This is going to be an exciting discussing these topics. Stay tuned. 29 Responses to Orientation Note. RITUK. Open a ZERODHA account. Chapter 2. Risk Part 1. 2.1 Warming up to risk. For every rupee of profit made by a trader, there must be a trader losing that rupee. As an extension of this, if there is a group of traders consistently making money, then there must be another group of traders consistently losing money. Usually, this group making money consistently is small, as opposed to the group of traders who lose money consistently. The difference between these two groups is their understanding of risk and their techniques of Money management. Mark Douglas, in his book The Disciplined Trader, says successful trading is 80% money management and 20% strategy. I could not agree more. Money management and associated topics largely involve assessment of risk. So in this sense, understanding risk and its many forms become essential at this point. For this reason, let us break down risk to its elementary form to get a better understanding of risk. The usual layman definition of risk in the context of the stock market is the probability of losing money. When you transact in the markets, you are exposed to risk, which means you can possibly lose money. For example, when you buy the stock of a company, whether you like it or not, you are exposed to risk. Further, at a very high level, risk can be broken down into two types: systematic risk and unsystematic risk. You are automatically exposed to both these categories of risks when you own a stock. Think about it. Why do you stand to lose money? Or in other words, what can drag the stock price down? Many reasons, as you can imagine. But let me list down a few. Deteriorating business prospects, declining business margins, management misconduct, competition eating margins. All these represent a form of risk. In fact, there could be many other similar reasons, and this list can go on. However, if you notice, there is one thing common to all these risks: they are all risks specific to the company. For example, imagine you have an investable capital of 1 rupee. You decide to invest this money in HCL Technologies Limited. A few months later, HCL declares that their revenues have declined. Quite obviously, HCL stock price will also decline, which means you will lose money on your investment. However, this news will not impact HCL's competitors' stock price, Mindtree or Wipro. Likewise, if HCL's management is guilty of any misconduct, then HCL's stock price will go down and not its competitors. Clearly, these risks are specific to this one company alone and not its peers. Let me elaborate on this. I'm not sure how many of you were trading the markets when the Satam scam broke out on the morning of the 7th of January 2009. I certainly was. And I remember the day very well. Satam Computers Limited had been cooking its books, inflating numbers, mishandling funds, and misleading its investors for many years. The numbers shown were way above the actual. Myriads of internal party transactions, all these resulting in inflated stock prices. The bubble finally burst when the then chairman, Mr. Ramalinga Raju, made a bold confession of this heinous financial crime via a letter addressed to the investors, stakeholders, clients, employees, and exchanges. You have to give him credit for taking such a huge step. I guess it takes a massive amount of courage to own up to such a crime, especially when you are fully aware of the ensuing consequences. Anyway, I remember watching this in utter disbelief. Udayan Mukherjee read out this super explosive letter live on TV as the stock price dropped like a stone would drop off a cliff. This, for me, was one of the most spine-chilling moments in the market. Watch the video here. I want you to notice few things in the above video. The rate at which the stock price drops, BTW. The stock price continued to drop to as low as 8 or 7. If you manage to spot the scrolling ticker, notice how the other stocks are not reacting to Satam's big revelation. Notice the drop in the indices, Sensex and Nifty. They do not drop as much as that of Satam. The point here is simple: the drop in stock price can be attributed completely to the events unfolding in the company. Other external factors do not have any influence on the price drop. Rather, a better way of placing this would be, at that given point, the drop in stock price can only be attributable to company-specific factors or internal factors. The risk of losing money owing to company-specific reasons or internal reasons is often termed as unsystematic risk. Unsystematic risk can be diversified, meaning instead of investing all the money in one company, you can choose to invest in 2 to 3 different companies, preferably from different sectors. This is called diversification. When you diversify your investments, unsystematic risk drastically reduces. Going back to the above example, imagine instead of buying HCL for the entire capital, you decide to buy HCL for 50,000 rupees per and maybe Karnataka Bank Limited for the other 50,000 rupees per. In such circumstances, even if HCL stock price declines owing to the unsystematic risk, the damage is only on half of the investment, as the other half is invested in a different company. In fact, instead of just 2 stocks, you can have a 5 or 10 or maybe 20 stock portfolio. The higher the number of stocks in your portfolio, higher the diversification, and therefore lesser the unsystematic risk. This leads us to a very important question: how many stocks should a good portfolio have so that the unsystematic risk is completely diversified? Research has it that up to 21 stocks in the portfolio will have the required necessary diversification effect, and anything beyond 21 stocks may not help much in diversification. I personally own about 15 stocks in my equity portfolio. The graph below should give you a fair sense of how diversification works. As you can notice from the graph above, the unsystematic risk drastically reduces when you diversify and add more stocks. However, after about 20 stocks, the unsystematic risk is not really diversifiable. This is evident as the graph starts to flatten out after 20 stocks. In fact, the risk that remains even after diversification is called the systematic risk. Systematic risk is the risk that is common to all stocks in the markets. Systematic risk arises out of common market factors such as the macroeconomic landscape, political situation, geographical stability, monetary framework, etc. A few specific systematic risks which can drag the stock prices down are degrowth in GDP, interest rate tightening, inflation, fiscal deficit, geopolitical risk. The list, as usual, can go on, but I suppose you get a fair idea of what constitutes a systematic risk. Systematic risk affects all stocks. Assuming you have a well-diversified 20 stocks portfolio, a degrowth in GDP will indiscriminately affect all the 20 stocks, and hence the stock price of stocks across the board will decline. Systematic risk is inherent in the system and it cannot really be diversified. Remember, unsystematic risk can be diversified, but systematic risk cannot be. However, systematic risk can be hedged. Hedging is a craft, a technique one would use to get rid of the systematic risk. Think of hedging as carrying an umbrella with you on a dark, cloudy day. The moment it starts pouring, you snap your umbrella out and you instantly have a cover on your head. So when we are talking about hedging, do bear in mind that it is not the same as diversification. Many market participants confuse diversification with hedging. They are two different things. Remember, we diversify to minimize unsystematic risk and we hedge to minimize systematic risk, and notice I use the word minimize. This is to emphasize the fact that no investment trade in the market should be ever considered safe in the markets. Not mine. Not yours. 2.2 Expected return. We will briefly talk about the concept of expected return before we go back to the topic of risk. It is natural for everyone to expect a return on the investments they make. The expected return on an investment is quite straightforward, the return you would expect from it. If you invest your money in Infosys and expect to generate 20% return in 1 year, then the expected return is just that 20%. Why is this important, especially when it sounds like a no-brainer? Well, the expected return plays a crucial role in finance. This is the number we plug in for various calculations, be it portfolio optimization or a simple estimation of equity curve. So in a sense, expecting a realistic return plays a pivotal role in investment management. Anyway, more on this topic as we proceed. For now, let us stick to basics. So continuing with the above example, if you invest 50,000 rupees per annum fee for a year and you expect 20% return, then the expected return on your investment is 20%. What if instead you invest 25,000 rupees per annum fee for an expected return of 20% and 25,000 rupees per in Reliance Industries for an expected return of 15%? What is the overall expected return here? Is it 20% or 15% or something else? As you may have guessed, the expected return is neither 20% nor 15%. Since we made investments in two stocks, we are dealing with a portfolio. Hence, in this case, the expected return is that of a portfolio and not the individual asset. The expected return of a portfolio can be calculated with the following formula. ERP equals W1R1 plus W2R2 plus W3R3 plus WNRN, where ERP equals expected return of the portfolio, W equals weight of investment, R equals expected return of the individual asset. In the above example, the invested is 25,000 rupees per in each. Hence the weight is 50% each. Expected return is 20% and 15% across both the investment. Hence, ERP equals 50% asterisk 20% plus 50% asterisk 15% equals 10% plus 7.5% equals 17.5%. While we have used this across two stocks, you can literally apply this concept across any number of assets and asset classes. This is a fairly simple concept and I hope you've had no problem understanding this. Most importantly, you need to understand that the expected return is not guaranteed return. Rather, it is just a probabilistic expectation of a return on an investment. Now that we understand expected returns, we can build on some quantitative concepts like variance and covariance. We will discuss these topics in the next chapter. Key takeaways from this chapter. When you buy a stock, you are exposed to unsystematic and systematic risk. Unsystematic risk with respect to a stock is the risk that exists within the company. Unsystematic risk affects only the stock and not its peers. Unsystematic risk can be mitigated by simple diversification. Systematic risk is the risk prevalent in the system. Systematic risk is common across all stock. One can hedge to mitigate systematic risk. No hedge is perfect, which means there is always an element of risk present while transacting in markets. Expected return is the probabilistic expectation of a return. Expected return is not a guarantee of return. The portfolio's expected return can be calculated as ERP equals W1R1 plus W2R2 plus W3R3 plus WNRN. 22. Open a ZERODHA account. Chapter 3. Risk Part 2, Variance and Covariance. 3.1 Variance. In the previous chapter, we touched upon the topic of expected return. Continuing on it, we will understand the concept of portfolio variance. Portfolio variance helps us understand the risk at a portfolio level. I'm hoping you are familiar with standard deviation as a measure of risk. We have discussed standard deviation multiple times in the previous modules. Refer to Module 5, Chapter 15 onwards. I'd suggest you get familiar with it if you are not already. While we can easily measure the risk of a single stock by calculating its standard deviation, calculating the risk of a portfolio is a whole different ballgame. When you put a few individual stocks together and create a portfolio, it becomes a different animal altogether. The agenda for this chapter is to help you understand how to estimate risk at a portfolio level. However, before we proceed, we need to understand the concept of variance and covariance. Both variance and covariance are statistical measures. Let's deal with the variance first. The variance of stock returns is a measure of how much a stock's return varies with respect to its average daily returns. The formula to calculate variance is quite straightforward, where Sigma 2 equals variance. X equals daily return. Micro equals average of daily return. N equals total number of observation. Note: the variance is measured as sigma squared. I will not get into the reasons for this as the explanation is quite complex and we could digress. For now, I'd request you to be aware of the fact that variance is sigma squared. Anyway, calculating variance is quite simple. I'll take a simple example to help us understand this better. Assume the daily return for a stock for 5 consecutive days is as below. Day 1 plus 0.75%. Day 2 plus 1.25%. Day 3 to minus 0.55%. Day 4 to minus 0.75%. Day 5 plus 0.8%. In this case, the average return is plus 0.3%. We now need to calculate the dispersion of daily return over its average return, and also square the dispersion. Daily return dispersion from average dispersion squared. Plus 0.75%, 0.75% to 0.3% equals plus 0.45%, 0.45% squared equals 0.002025%. Plus 1.25% plus 1.25% to 0.3% equals plus 0.95%, 0.95% squared equals 0.009025%. Minus 0.55% minus 0.55% to 0.3% equals minus 0.85% to 0.85% squared equals 0.007225%. Minus 0.75% minus 0.75% to 0.3% equals minus 1.05% to 1.05% squared equals 0.011025%. Plus 0.80% plus 0.8% to 0.3% equals plus 0.5%, 0.50% squared equals 0.002500%. We now sum up the dispersion squared to get 0.031800%. We divide this over 5 and to get the variance, i.e. 0.031800%. 5. Sigma 2 equals 0.006360%. So what does this number tell us? It gives us a sense of how the daily returns are spread out from the average expected returns. So you as an investor should look into the variance to determine the riskiness of the investment. A large variance indicates that the stock could be quite risky, while a small variance can indicate lesser risk. In the above example, I would consider the variance high, since we are looking at just 5 days worth of data. Now, here is something you may be interested in knowing. Variance and standard deviation are related to each other by the following simple mathematical relationship. Square root of variance equals standard deviation. We can apply this to the example above and calculate the 5-day standard deviation of the stock. Percent. Approximately 0.8%. Which is the standard deviation, aka the volatility of the stock over the last 5 days. Anyway, at this point, I want you to be aware of variance and what it really means. We will eventually plug variance along with covariance into the portfolio variance equation. 3.2 Covariance. Covariance indicates how two or more variables move together. It tells us whether the two variables move together, in which case they share a positive covariance, or they move in the opposite direction, negatively covariance. Covariance in the context of stock market measures how the stock prices of two stocks or more move together. The two stocks' prices are likely to move in the same direction if they have a positive covariance. Likewise, a negative covariance indicates that the two stocks move in opposite direction. I understand covariance may sound similar to correlation. However, the two are different. We will discuss more on this further in the chapter. I guess calculating the covariance for two stocks will help us get a grip on understanding covariance better. The formula to calculate covariance of two stocks is as follows, where RTS1 equals daily stock return of stock 1. AVG RTS1 equals average return of stock 1 over n period. RTS2 equals daily stock return of stock 2. AVG RTS2 equals average return of stock 2 over n period. N, the total number of days. In other words, you can calculate the covariance between two stocks by taking the sum product of the difference between the daily returns of the stock and its average return across both the stocks. Sounds confusing? I guess so. Smiley face. Let us take up an example and see how we can calculate the covariance between two stocks. For the sake of this illustration, I've selected two stocks, Cipla Limited and Idea Cellular Limited. To calculate the covariance between these two stocks, we need to work around with the above formula. We will resort to good old Excel to help us implement the formula. Before we proceed, if you were to guess the covariance between Cipla and Idea, what do you think it would be? Think about it. Two large corporate, similar size, but in two completely unrelated sectors. What do you think would be the covariance? Give it a thought. Anyway, here are the steps involved in calculating covariance in Excel. Note: although there is a direct function in Excel to calculate covariance, I'll take the slightly longer approach, just to ensure clarity. Step 1. Download the daily stock prices. For the purpose of this illustration, I've downloaded 6 months data for both the stocks. Step 2. Calculate the daily returns for both the stocks. Daily returns can be calculated by dividing today's stock price over yesterday's stock price and subtracting 1 from the result of this division. Step 3. Calculate the average of the daily returns. Step 4. Once the average is calculated, subtract the daily return by its average. Step 5. Multiply the two series calculated in the previous step. Step 6. Sum up the calculation made in the previous step. Take account of the number of data points. You can do this by using the count function in Excel and giving any of the fields as the input array. I've used the count on the dates here. Step 7. This is the final step in calculating the covariance. To do so, one needs to divide the sum by count minus 1, i.e. n1. The count, in this case, is 127. So count 1 would be 126. Sum calculated in the previous step was 0.006642. Hence, covariance would be equals 0.006642, 126 equals 0.00005230. You can download the Excel sheet. As you can see, the covariance number is quite small. However, that's not the point here. We only look at whether the two stocks share a positive or negative covariance. Clearly, since the two stocks share a positive covariance, it means that the returns of the two stocks move in similar directions. It means that for a given situation in the market, both the stocks are likely to move in the same direction. Note: covariance does not tell us the degree to which the two stocks move. The degree or magnitude is captured by correlation. The correlation between Idea and Cipla is 0.106, which indicates that the two stocks are not tightly correlated. By the way, here is something very interesting fact. The mathematical equation for correlation between two stocks is as follows, where COVXY is the covariance between the two stocks. Sigma X equals standard deviation of stock X. Sigma Y equals standard deviation of stock Y. Note: the standard deviation of a stock is simply the square root of the variance of the stock. Here is a task for you. We have calculated the correlation between Idea and Cipla using the direct Excel function. Can you confirm the accuracy by implementing the formula? Anyway, in the case of building a stock portfolio, do you think a positive covariance is good or bad? Or rather, do portfolio managers desire stocks in their portfolio which share a positive covariance or they don't? Well, portfolio managers strive to select stocks which share a negative covariance. The reason is quite simple. They want stocks in the portfolio which can hold up. Meaning if one stock goes down, they want at least the other to hold up. This kind of counterbalances the portfolio and reduces the overall risk. Now, think about a regular portfolio. It will certainly contain more than 2 stocks. In fact, a good portfolio will contain at least 12 to 15 stocks. How would one measure covariance in this case? This is where things start getting complicated. One will have to measure covariance of each stock with all the other stocks in the portfolio. Let me illustrate this with the 4 stocks portfolio. Assume the portfolio is like this: AB, Cipla, IDEA, Wipro. In this case, we need to calculate the covariance across AB, Cipla, AB, IDEA, AB, Wipro, Cipla, IDEA, Cipla, Wipro, IDEA, Wipro. Note: the covariance between stock 1 and stock 2 is the same as the covariance between stock 2 and stock 1. So as you can see, 4 stocks require us to compute 6 covariances. You can imagine the complexity when we have 15 or 20 stocks. In fact, when we have more than 2 stocks in the portfolio, the covariance between them is calculated and tabulated using a variance covariance matrix. I would love to talk about this now, but I guess I will keep it for the next chapter. Stay tuned for more. Key takeaways from this chapter. Variance measures the dispersion of returns over the expected average returns. Higher variance indicates higher risk. Lower variance indicates lower risk. Square root of variance is standard deviation. Covariance between the returns of 2 stock measures how the returns of the 2 stocks vary. A positive covariance indicates that the returns move positively, and a negative covariance indicates that while one stock returns moves up, the other comes down. Correlation measures the strength of the movement. Covariance between 2 stocks divided over their individual standard deviations results in a correlation between 2 stocks. When we have more than 2 stocks in a portfolio, we compute the variance covariance using a matrix. 14 responses to risk, part 2, variance and covariance.